Good evening, members. I welcome you to today's session. I hope that you will find it very, very beneficial. Sorry for the late start. We had a few technical issues that we've been trying to handle, but we hope that you will have a great evening this time. Today's topic is one that is very, very insightful. And it is insightful because many of us have in one way or the other gotten into debt. And I know that from today's session, you're going to take one thing or two that you can always apply in your life, whether you're going to get debt, whether you're thinking about getting debt, whether you've previously had debt. Today, you're going to be thinking and rethinking and also considering some of the strategies that you're using, some of the reasons that you get debt, and some of the reasons that you may be struggling with your current debt, some of the considerations that you may need to make as you're going to take out your future debt. So I'll encourage you to be as interactive as possible. Where called upon, please share your experiences, share your insights, share some of the lessons. I know in the session we have people who are bankers, we have insurers, we have personal finance enthusiasts, we have students, we have people of all categories. And I know that in one way or the other, each of those categories has interacted with debt. Either they have given out debt, they have gotten debt, they have had a family member who had debt, they have lived the consequences of debt, and some are regretting, some are enjoying the fruits. And that's why we thought it very important to share with you about debt. If today is your first time to join our session, my name is Darius Nkwasiwe. I'm a team leader at Next Life Finance, and we always have financial literacy sessions. We engage different communities, schools, investment clubs, circles, communities, churches. If you'd like to get in touch with us, we are always delighted to interact and partner with you so that we can help you to get better with your personal finances. Also, key to note is that every Sunday we have these free personal finance sessions from 5 to 6 p.m. So if today is your first time to join in, you may want to consider coming back next Sunday. And we also have a WhatsApp community that you can always rely on so that you never miss out on any of the information that we put out there. The WhatsApp sessions and these online sessions started when the COVID pandemic hit. That was around 2020. Previously, we were having physical sessions, physical paid sessions, which we had put a halt because of the situation that we are in. We are trying to see how can we continue empowering our people that had attended our courses, and those that depend on them, and those that would like to learn more about personal finances. Of course, when the pandemic came in, we thought it wise to go virtual. And when we went virtual, we've seen more people impacted, more people learning, and more people willing to share. But since the economy is now fully open, we'll soon be starting our physical paid sessions so that you can get to interact with myself, our speakers, and the rest of the team at Next Life Finance. So we welcome you to today's session, and I hope that you're going to find deep value. If you're watching this session live, or if you're tuning in live, I welcome you. And if you're one of those people that is going to listen to the recording later, because the recording is going to be hosted on YouTube, you're also welcome. Please interact with the rest of the materials. I encourage you to visit our YouTube channel. It's called Personal Finance with Darius, and you're going to be able to find all the content that we've had from our previous sessions ranging from setting and managing finance goals, financial discipline, maximizing your employment income, life insurance, creating multiple streams of income, developing a savings culture, sessions like investing in unit trusts, understanding investments and savings and what differentiates them and how to do it right, how you can avoid Ponzi schemes, and many more sessions that when you visit the YouTube channel, which is Personal Finance with Darius, you'll be able to find all this information, and you'll always learn a great deal. You can also use the feedback, the YouTube channel, to always give us your feedback. about the sessions using the comment section. In fact, if you're joining in for the first time, I'd like to ask you, you can right now go to the YouTube channel and subscribe so that you never miss out on any of the sessions that will come through to you in future. Important to note is that these sessions are brought to you in partnership with the Authority Club of Rubaga, which is a community of young professionals who meet and interact to solve the challenges in our communities. The Authority Club of Rubaga and its members are very, very key partners in ensuring that these sessions are happening to us. So you might want to check out Rubaga and what Rubaga does. I see the president and a couple of members are tuned in. You're very welcome and thank you for tuning in. So straight to today's topic, which is good debt and bad debt. What's the difference? What are the characteristics? And what do you get to learn out of there? So before I move forward, I would like you to type in the chat room. I would like you to type in the chat room. If you can hear me, please confirm with the Y. I don't want to continue to the session only to realize that I was speaking to myself. Okay. Thank you. Thank you for confirming that you can listen to me. So today's session is going to be very interactive, but before we get there, I would like to first give you some hints or give you some insights about what is good debt and what is bad debt so that we can move at the same pace. I know that some of us, these concepts may be new to us, and typically we've grown up being told that debt is bad. Try to avoid debt as much as you can. Yet, in one way or the other, we see other people thriving on debt. Someone tells you, I have this bank loan, I have the other bank loan, and then you see the person thriving. They are not stressed out and they are enjoying themselves. And on the other hand, you see someone is struggling, they take out debt, but repaying it back is a challenge. Making sure that they meet the reasons why they took the debt is a challenge, and they struggle through it. As a result, they are stressed, they are depressed, and they are always wondering, who cast me? I never make progress with my money. I don't see where my money goes. All my money goes to the bank. And as a result, many people end up cursing and saying that banks are robbers, that they are thieves, and therefore they do not encourage anyone to use banks because the experience that they have had with banks is not some of the best. But as we will see from today's session, there are key considerations that you may want to consider, and sometimes if you don't put them into consideration, you're going to consider banks your enemies, you're going to consider lenders your enemies, and you'll end up cursing anything called debt. In our group, the personal finance group, someone shared a poster from one of the lenders around town, and all people were sharing all these kinds of negative experiences that they have had with that lender. They were saying that the interest is very high. They were saying that this person makes sure that they frustrate you when you try to get debt, to make sure that they take your collateral. They were trying to say that I think there is a code that is put onto your payroll, and before you get it out of there, it's going to be a hassle. Sometimes you may have to involve government authorities to have this taken off so that deductions are not made on your salary anymore. So all these are some of the things that we need to look at, and so that we can determine whether we are actually taking good debt or bad debt, or whether we are using debt what it is meant to be used for. So someone might ask, what is debt? Okay, I know it could be something that may seem obvious, but in simple terms, debt is something, and usually money, that is borrowed by one party from another. So it means that I could go to a bank and ask them to give me money, and when they give me money, I'll remain owing them that money that I would have borrowed, and probably plus some interest. So that is debt. I have debt. It could also be as simple as me going to my friend Jacinta and asking that, could you please lend me 100,000? Whatever I want to use it for, maybe she may not know, she may know, but once she gives me that money, I have debt. It could be as simple as asking your mom to give you some little money, and you promise them that you'll pay it back. So as long as you promise that you're going to pay it back, and she indeed gives it to you, expecting that you're going to pay it back, that is debt. So debt is not just it's not just the bank loans that we acquire for those of us who are able to get them. Even the monies that we borrow from our friends is debt, and we should treat it as that. And if we treat it as that, it means that we'll be able to pay it back when it's time to pay it back. Some of us think that what we get from the bank is what is debt, and therefore we are obliged to pay it back. But if it's not, if it's just from a friend or from a relative, I can play around with it, and even if I don't pay it back, but it's debt, and someone is already expecting it from you. So many companies or corporations and individuals use debt. In fact, I was reading out some statistics, and they were saying that more than 50% of adults that are working have debt at any one point, at any one given point. More than 50% of people that are working have debt. So there are many, and many companies also get debt. And they get debt for many reasons. It could be for expanding their business, maybe acquiring new machinery, doing some renovations around their premises. It could be acquiring new systems. There are many reasons that people and companies acquire debt. For the purpose of this session, we'll focus more on debt by individuals. And this is why it's personal finance. So we will not focus more on debt taken up by companies, but I may bring in some examples from companies just in case it will be necessary for us to hammer the point home. So usually debt is taken when someone cannot afford something that they would like to purchase under normal circumstances. It could be land, it could be a house, it could be a car, it could be a fridge, it could be a TV, it could be as simple as it could be as simple as a laptop, it could be as simple as a phone, it could be as simple as a bag, anything that you need, but then you realize that you cannot afford it under normal circumstances, so you will have to take out a loan or a debt so that you can be able to afford it. So debt can be secured, unsecured, revolving, or mortgaged. Of course, these are terminologies that you can always dig out more, but typically secured means that you can get it without being asked to offer in something as collateral, and vice versa. And revolving, you might find that you have, there's a certain pool of money where you can go borrow and then pay back. Once you pay back, again, borrow up to a certain amount. Many of you have heard about mortgages, especially those who have thought about acquiring homes, or those that have worked in banks, you know this, or those that have been very particular about growing their financial acumen. You've heard about some of these terms. In most cases, debt is going to have to be repaid with interest, and the interest that you're going to pay is going to vary from the type of debt that you're taking, plus the source, of course, plus other terms and conditions. Like, for example, that if you're taking a consumer debt versus an asset debt, you may find that the interest is going to vary. If you're taking your loan from a bank versus the other money lenders, or what we call loan sharks, the interest is going to vary. Typically, banks are going to be lower than the loan sharks. Also, some other terms and conditions. Maybe there are specific reasons for why you're borrowing, and that could determine what interest you're going to pay, or you're going to be expected to pay. For example, many the government programs, as well as financial institutions, if they want to spur economic activity, maybe they want to encourage youth to start up businesses. They'll give them interest that are a little bit lower, or they will give them interest-free debt, as long as there's something that they are trying to push for. And then in most times, if they're trying to discourage people from taking loan, the loan interest will be a little higher. Sometimes the economic situation that we are in is going to determine what kind of interest the banks and financial institutions or the people that you get it from will give you. If you're in a workplace, some workplaces will give soft loans to their staff in order to enable them manage some of the financial hurdles that they go through, and you'll find that the loan will either be interest-free or will have a very, very lower interest rate. So the source from which you get the loan from, the type of loan that you're getting, and also the terms and conditions attached are going to determine what kind of interest you get. Now, as we get along the session, you're going to realize that all those factors we are going to have them in to ensure that hello members, I ask you to kindly mute so that we do not affect the rest of the people that are settled in. So I was saying also the kind of interest that you get on your loan is going to determine whether you have good debt or bad debt. So let's move on. Okay, so before we get into what is good debt, what is bad debt, I think it's also imperative that we appreciate some of the reasons why people get into debt. And maybe once we dissect these and then we get into discussing what differentiates good debt and bad debt, you will make an informed choice or an informed decision. And as I walk through some of these, ask yourself which one relates with me. So some of the reasons, poor money management. So many of us don't budget, we do not track our expenses, we do not save, and as a result, we find that the income that we have cannot sustain our needs or cannot sustain our financial desires, and therefore we have to look for an extra hand. And because of that, we get into debt. Also, lack of self-control and discipline with our spending comes a lot into one of the reasons why people get into debt. So you find that you have a salary that is up to a certain limit, but whenever you're in town, whenever you're in a supermarket, whenever you're going to shop, you do not control yourself. You do not have anything that will control you and know that I'll spend up to this limit. For you, will just go. You see a good bag, you buy. You see a good shoe, you buy. You see a nice car, you buy. You see your friend having something, you buy. Okay, so once we fail to control ourselves, we are typically going to find ourselves into debt. But then also pride. So some of us worry about what the rest of the people will think about us. Some of the people want to maintain a certain status, and because of that, we find ourselves into debt. So you may find that because you work with a certain company, you think that you need to have a certain brand, a certain caliber, you need to live within a certain area. Yet ideally, you can't afford it. And as a result, the income that you have is not going to be sufficient for you. And what happens? You're going to run to debt to be able to sustain your lifestyle. But also, it is important to note that not everyone that gets into debt is because they have failed to manage their money, they do not have control, or they have pride. Some people, it's out of absolute necessity. You do not have a single source of income, but in one way or the other, you have to survive. Maybe if you have a family, you have to find food, you have to find shelter, you have to find clothing for your children, for your wife. You have to cater for them. Maybe you had a source of income and it was affected for one reason or the other, like many people were affected during the COVID-19 pandemic, and then you have to survive. Of course, you won't say that I will not take out debt because I know it is either it's not good for me or it's bad for me, but you will have to, because you have to survive. And that leads to reduced income. So some of us are living a certain lifestyle because we are earning a certain amount of money on a monthly basis, on an annual basis. But maybe over time, because of one reason or the other, you might find that your income reduces, yet you want to maintain a certain kind of lifestyle. Because of that, you're going to be forced to take on debt to be able to sustain it. We'll be discussing whether that is good or bad debt. And then limited savings. So many of us, and I say this without fear of contradiction, many of us struggle to put aside some savings. So whatever income we get, we utilize, we spend. Whatever income we get, we utilize, we spend. We buy this, we buy the other. We go out hanging, we do everything apart from saving. And then at a certain point P, you realize that you have an emergency. And you have an emergency that has to be dealt with, but you do not have enough savings to deal with that emergency. So what you will have to do, you will have to go for debt so that you can be able to deal with this emergency. But if we are deliberate about making sure that we have an emergency fund, we nurture it and we grow it over time, we will be able to have enough resources that in case a calamity or an emergency came in, you'll be able to handle it. And then lastly, I've been interacting with many youth of recent, and I've realized that many of them out there, especially around the city, are addicted into gambling, betting. They think that they will put in some money and bakubo muyindi. That's the thing, the words they use. So at first, the money can seem little, but I've interacted with some youth who you find that when you try to dig out the reasons for their debt, or ask yourself, but you're not working, why? And you're still under the roof of your parents and they cater for your needs, but why do you have debt? Why are you always running here and there looking for some money to borrow? But it's because of gambling. It becomes addictive once they start doing it over time, and they feel like they can't live without it. So they will always look out for money, and as a result, they get into debt. Is that debt necessary, or is it good debt? We are going to be discussing that in a short while. So having said that, what is good debt? So and I know many of the people came here to learn what is good debt, what is bad debt. So good debt typically has lower interest rates and is considered an investment for the future. Like I said when I was starting, many of us have grown to be told that debt is bad, that you should try to avoid debt as much as you can. As a matter of fact, I know some regions that will ask you not to take on debt. Well, for whatever doctrine that they have, they are justified, but there are aspects where debt is going to come in handy and is going to be good. Good debt gives you something that we call leverage. And how does it give you leverage? You find that it will help you to do something that you couldn't do now, but you do it in the future. And as a result of that, you're going to increase your net worth. And if you're borrowing this for the sake of your business, you'll find that it is going to increase the net worth of your business. Maybe for those who might wonder, so what is my net worth as an individual? So your net worth is going to be based on the difference between your assets and your liabilities. So if your liabilities are more than your assets that you have, you're going to find that your net worth is going to be in negatives. And if your assets are more than your liabilities, you're going to find that you will have a positive net worth. And it will increase the more you increase your assets, and it will decrease the more you increase your liabilities. So when you take out good debt, it is going to help you to increase your net worth. I'll give some examples. So for example, you could spot a good plot of land that is in a prime area. But given the circumstances you're in at that very moment, you're not able to purchase it with cash. And then you ask yourself, so if I bought this piece of land, how much value is it going to be in 5 years from now? Maybe currently it's at 10 million, but realize that if I bought this piece of land, given the economic activities around the area, given the circumstances, the housing needs, and whatever I could be able to do with this plot of land, it's going to increase in value. And in 5 years from now, I could sell it at 30, 40, 20, or 50 million. That means it is going to increase. Then you realize that actually, if I can take out a loan that is maybe as low as 10%, 12%, and 9%. I belong to a circle that gives out a loan that is 7% if you're purchasing land. You realize that I'm going to take out this loan at a low interest rate, and I'll be able to pay it within 2 years. And my total interest is maybe going to be maybe 2 million out of the 15 that I'm purchasing this land and I'm getting the loan for. So after I've paid it, after the 3 years or 2 years, whichever period that I will have taken, the loan plus the interest will be 17 million in total. But my piece of land is going to be 25 million, is going to be 30 million. So in terms of my assets, they are growing in value. And that means that my net worth is increasing. But also, if you're borrowing it for the sake of a business, you could have your business now, but you cannot afford a certain level of stock because what you have is actually very limited. So you ask yourself, so if I took out this business loan and made sure that the kinds of profits that I'm going to make from my business, they will be able to cover the interest rate that I'm charged, and in fact remain with something. So over time, your business is going to grow because you can afford more stock, and because you're affording more stock, your business is going to keep expanding, and the more it expands, the more its net worth increases. So maybe if your business is currently 10 million, you may realize that in 5 years, if you'd like to sell it, it will maybe be 50 million, 100 million, based on the kind of debt that you took out to be able to expand it. For someone who is into manufacturing, you could use debt to purchase some of the latest machinery, which will increase your production capacity, and as a result, your business is going to grow. And as it grows, as you produce more, and then you bring in more machinery, you expand, the net worth of your business is going to increase. Even the machinery that you've brought in can increase the net worth of your business. So those are some of the things that you look out for in good debt. But also the other thing is that good debt has future value. So when you are purchasing, when you're getting debt and you're going to purchase something, you must ask yourself, whatever I'm going to buy using this debt, what's the future value? So for example, if I bought a piece of land and in the future it's going to increase in value, that means that that debt is going to be good debt, or it's going to be considered good debt. Or I could take it out to purchase a real estate property that I know that once I've purchased it, the cash flow that comes in from the tenants is going to be able to sustain the debt, but I'll maintain my house. And the house that I would have purchased having tenants is going to increase in value over time. You can imagine someone who had a house in areas like Namugongo 10 years back, the value that it was then and the value that it has now. 10 years back, you couldn't have imagined that it could be a town like it is currently. So can you imagine someone who got some considerable debt and bought land and put up a good building, or purchased a property there? Can you imagine how much value they have gained over time? Like I mentioned, the purchase has outlast the debt. So if you're getting debt and you're going to purchase something, but this thing that you're going to purchase is going to is going to cease before you finish paying for your debt, that is bad debt. You need to run away. Good debt, what you purchase with it will have to outlast it. So if I'm purchasing something and my debt is to be repaid in 5 years, and I can pay it in 5 years without constraining any of my financial goals, then that means I am having good debt. And then the ratio of debt to income is very minimal. So you realize that when you get debt, all the debt that you have divided by your total income, if you realize that the ratio is high, you might need to rethink that kind of debt that you're going to take. Or if you've already taken it, you may have to reconsider some of the strategies that you have at hand to make sure that you can reduce it. And so, like I said, the debt to equity ratio should be about just get your total debt divided by your income. So if you find that the figure that you get is higher, maybe 2-to-1, you might have to reconsider your strategies, and you may have to ask yourself, so what are some of those things that I can do to reduce on this debt because it is going bad? So up to this point, I would like you to take some time and type in the chat some examples of good debt, or some examples of purchases that you can make and you know that I have good debt. Please type in the chat so that I can know that you're following and that I'm not talking to myself. What are some of the examples of good debt? If you're following, type something so that I can know. Wonderful. Mary Nursery says, when purchasing an asset that appreciates in value, e.g. land, borrowing to increase on inventory stock. That is from William Chizito. That's wonderful. More people to share their examples. More people to share examples. What would you consider as good debt? Mary Patricia says, buying an equipment that is needed at work to bring in more money. Wonderful. Catherine says, purchasing land with a loan in a good area. Wonderful. Expanding business, school fees from Philip Chiriowa. That's wonderful. So yes, those are some of the things that you're going to realize that you will consider as good debt. So mortgage could be good debt. Brent, is it good debt? Let me talk about it in a moment. And then borrowing to add into a business already experiencing lucrative profits. Wonderful. That's Carol and Mary. So thank you, members, for following through. Then getting a loan to buy a border, is it good debt? Wonderful, wonderful question that I'm going to respond to in a moment. So let me first pause there and respond to the questions that we have. Yes, so if I'm getting a loan to purchase a house, is it good? Is it good debt? In most circumstances, it is going to be good debt, because I mean, we all need shelter in one way or the other, and we need where to sleep. But maybe what I'll need to ask, what is the value of the house that you're building or that you're buying, and the interest rate that you're being charged? For example, I've seen people get interest that is as high as 10% per month, not per annum, and then using that to construct a house in the village. I would struggle to call that good debt. But if you went, for example, to a financial institution that has mortgages, and maybe they're giving you a loan as low as 16% per annum, you could consider that good debt. If you're buying a border, yes, definitely. If you're buying a border for the purpose of it bringing in for you money, in most cases, and from the experiences that I've interacted with border guys, it is going to be good debt. Boda Boda has potential to bring in cash flow and pay itself within 2 years, and then you continue using that Boda Boda for the next 5 years or even more, depending on how the person that is riding is using it. So yes, if you're getting it for the purpose of it generating for you income, many Boda Bodas that I've seen are very lucrative, and that becomes a good debt. All right, so we had more examples: purchasing land, building rentals, and an airline purchasing a new aircraft to their fleet. Wonderful, because that means that they are going to add on the revenues that they are able to make. Thank you very much. So let's move on and look at some of the things that might make debt bad. So bad debt typically has higher interest rates and can be prevented with smart use of money. So if you realize that you're purchasing something, that maybe it's because of your poor use of money, because of your bad behaviors, you're moving into what we call bad debt. So some of the things that will give you a hint for you to realize that I'm actually getting into bad debt and I should avoid it as fast as I can, as follows. The cost outweighs the benefits. In our group, the Personal Finance Mastery Group, someone was discussing how they went to one of the prime lenders around town, and once they parked their car was towed because either this person had failed to pay, but from the example they were giving, they were saying the lender was just frustrating this person that had borrowed money, and they just wanted to attach their property or their collateral. So there you realize that you're taking out loan, but at the end of the day, you lose out the benefits for which you thought you were going to look out for. That is bad debt. That is a red flag. Run for your life. It keeps you in an almost perpetual debt. I've been able to interact with many civil servants. I've been able to interact with many salaried people who take out salary loans, and then they use them to fund their lifestyles. And as a result, they are in constant debt. Salary loan after salary loan, top up after top up. So they never cease. In fact, I know someone who I'm very close to. They are retiring in 2 years from now, but they still have bank loans. But if you ask them, what did these loans do for you? They did not have something to show for it. And they were discussing with me, and they were looking out for strategies that they can use, because they are now starting to get worried about their retirement. They took out loans and it became like a lifestyle. That is bad debt. And this usually comes in when you're choosing to when you're getting debt to fund your lifestyle. And then it keeps you from reaching your long-term financial goals. So if you realize that the loan that you take out and the purchases that you're going to make and the interest rates that are associated with it will prevent you from reaching your long-term financial goals, then you can know that that is bad debt, and you should run for your life. But also important to note is that if the items that you're going to buy with this debt are going to depreciate immediately, that is bad debt, and you need to run for your life. Also, if that debt is going to leave you with nothing to show for it, that is bad debt. You need to run for your financial life. So, for example, some of the items that depreciate immediately once we've purchased them, and many of us might know, many of us feel that we actually need them, but sometimes we actually don't, depending on your situations, is a car. And I know some people may not want to listen to this, or some people may think that a car is a necessity that they must live with. But a car is something that once you get out of the bond, its value starts depreciating. And the moment you want to sell it, you're typically going to get a lower amount than you purchased it. Think about household items, a fridge, a TV. You want a bigger screen to be able to show whatever you've purchased. All these things, they're typically going to depreciate in value. So if you're If you're purchasing something that you call an asset, but it's going to depreciate immediately, that is a bad debt. Run for your life. Some of these things we need to fund them with cash or with money that we already saved somewhere, so that it does not burden us and ruin our financial life and prevent us from achieving our financial goals. So I would like to encourage you to look at whatever you're purchasing, so that you know, is it leading me into bad debt or good debt? But also, if it's a business and you're choosing to purchase something with a loan, but this whatever you're purchasing is not going to increase on your cash flows, or either in the present or in the near future, you might be going for what we call bad debt for your business. And that's why you've seen some businesses thrive until they start taking out debt. When they start taking out debt, it starts becoming a hassle, and then that becomes the start of the decline for this business. So you need to ask yourself, and remember, the more some of these financial institutions see you start to progress and start to get better with your business or with your entice you to be able to acquire debt from them. But what are you going to use that loan for? Okay. So you need to be asking yourself, this loan that I'm getting, what am I buying? What am I buying? What will I be able to see 5 years from now, 10 years from now? Will I see something and say that because of the other loan that I got, I was able to buy this, and I can say that I'm very proud of it? So before I move to the next slide, I would like to mention that I would like to give a brief hints from where we started and where we are now. So many of us have been brought up to believe that debt is bad, but debt can be good depending on what you use it for. Also, while debt can be good, and while debt can help us to leverage whatever we are doing for a better financial future, it can also be bad depending on what we use it for. So if you find yourself in a ditch of bad debt, you find yourself, you're already struggling with bad debt, should you hang yourself? Should you give up? Or should you just say that because I'm already in, I can continue moving forward? Hell no, it doesn't have to be that way. So you can do something to get a little bit better. And there's always light at the end of the tunnel, especially if you're part of such sessions, our financial literacy sessions. There are things that you can do to be able to get better. So some of these things include, I'll ask you, especially if it's personal loans, if it's personal debt, but also even if it's a business loan or debt for the purpose of your business, making sure that the way you're operating, you have a budget and you stick to it. These are some of the things that we discuss a lot in our sessions, but I get surprised when I meet or when I interact with some of the people that are part of these sessions, that people choose not to have budgets. People think that they will have their budgets in their heads, and their heads will work to manage their finances, but it cannot work that way. When you have a budget, it will help you to look critically at your incomes and also look critically at your expenditure. And what that does is that when you realize that your expenditure is higher than your income, you can then start to look for where to trim, so that you don't find yourself living beyond your means, which will necessitate you to go into bad debt that is required to finance your lifestyle. So you can consider doing what? You can consider making sure that you have a budget and stick to it, so that you can be able to track your finances. And then in the moment that you find yourself, you have to take out a loan, maybe for a good cause, maybe it's because of necessity, for whatever reason that you're taking out for, ensure that you read the fine print. Now, I'm one of those people who will go to a bank and will ask some of these questions that these people will consider to be very obvious. But I never want to take any chance, even if I'm just depositing money or opening up an account. Now, many of us don't have that habit to the extent that when we choose to take out loan, we do not read what the terms are. We do not read what is expected of us. Some of these loans have deadlines, and if you fail to meet those deadlines, your income gets doubled. Look at it this way. I've seen many people who take out these mobile loans from the telecom companies. Mocash is an example from MTN. Then there's Uewole from Airtel. Do you know that a loan from Mocash costs you 9% per month? So when you do 9% times 12, what is the figure? Around 72, 84, whatever the figure is. Those who are good at math can do that. You see that you're paying a lot of interest, but some people don't realize that they're actually paying 9% per month. For them, they think I'm taking out a loan and it's a quick loan, and I know that I'll have it sorted. And so I've seen many people who then go ahead. They borrow this month and then they fail to pay because they do not know the consequences. But you know that when you read the terms and conditions of the Mocash agreement, you will find that once you default to pay by the 30th day of since you took out that loan, that you get to incur double the interest that you had paid earlier. So if you are supposed to pay 9%, the next month that you add, you will have another 9% to add. If you fail to get, you find that you find that you have another 9%. In 3 months, you're paying 27%, and that is very high. Yet, maybe sometimes you may be in a real fix that if you read and understood, yes, you could take out the loan, but the moment you have the money, you pay it so that you stop digging yourself deeper into this hole. And then, most importantly, continue improving your financial knowledge. That's the reason why we have these sessions every Sunday. That's the reason why we have paid financial literacy sessions that we would like to invite you to come and be part of. That's why we have a YouTube channel where these sessions are posted, and we would like to welcome you to visit the YouTube channel, which is Personal Finance with Darius, and make sure that you subscribe. Check out most of those sessions that we've had so that you can be able to learn. So you need to increase your knowledge, you need to read books, you need to attend seminars, you need to attend such sessions, you need to read articles, you need to read blogs so that you can increase your knowledge. You increase your knowledge on how to make more money, you increase your knowledge on how to budget and manage the money that you would have made. You'll get tips on how to save and invest. And some of these things are going to help you to avoid what we call bad debt. Also, increasing your financial knowledge means that once you get this loan, you're going to use it for the right purpose. And when you use it for the right purpose, you are going to have what we call leverage, create wealth for yourself, increase your net worth, because the loan that you got, you utilized it well, and therefore you're getting value out of it. And therefore it is translating into what we call good debt. So that's it from me up to this point. So I would like to welcome another set of questions before we close off this evening's session. Another set of questions so that we can close off this evening session. I can see a few questions here in the chat. So, but maybe before I welcome the questions, I would like you to type in the chat, what are some of the examples of bad debt? What are the examples of bad debt? Please type in the chat so that I can know that you've been following and that you've understood what is bad debt, what is good debt. Okay, William says borrowing to buy a Porsche car, borrowing for liabilities like a personal car. That's from Justina. Wonderful, thank you. more examples of bad debt, please share them so that I can know that you've been following and that you've understood what bad debt is. Mary Nassali says a bad debt for depreciating assets, e.g. personal car, getting topics. Okay, Catherine Ruth, I think I'm not getting it well. Getting topics to do loans every time. Too high rated business loans. Yes, that is true. Borrowing for a holiday. That is wonderful. Some of these things we just need to save for them. That was Brenda. And then we have borrowing for a lavish wedding. Yes, that is very true. That was from Okech. Then Nasari says borrowing for one-off non-income generating activities, e.g. wedding. That is correct. So I see many people are telling us about parties, cars, buying for those things is bad debts. Borrowing for top-up loans, wonderful. Yes, especially if you do not know how to put your things right. Gambling, wonderful. Borrowing to buy the latest iPhone. Yes, President Jacinta, you're right. Eunice says borrowing for a fancy wedding, borrowing for a vacation, Ponzi schemes. Yes, someone comes and promises you how this thing is going to make you money in the shortest time, and then you have to borrow to join them, and they will surely give you assurance how you need to borrow money from someone so that you can join their business. If you find someone who is encouraging you that, can you please borrow so that you come and join, and then you invite your two friends, then you'll be able to make your money and pay them back in 1 week, my friend, run for your dear life. Yes, yes, there are lots of examples coming through. Thank you very much for sharing, John Sempala, William Chizito. Yeah, then someone says the bank loans agreements are like software agreements. You either agree or not. Borrowing on behalf of a friend or a relative, yes. Borrowing for a church offering or ties, correct. Yes, thank you members. Thank you for those examples. So please allow me to go back to some of the questions that were shared in the chat room. Thank you for the examples. So William earlier asked, please highlight on the major drivers of commercial banks' prime lending rates in relation to the central bank rate. The correlation between 19.5 and 6.5%. Respectively seems to be so negative. And I think, yes, thank you, William. Thank you, William. So William was asking. So yes, William, in a country like Uganda, you may find that there may not be a positive correlation between the central banking rate and what banks offer us because of a number of reasons. One is that they have to meet their expenses. Those buildings that they are in, some of them are rented. They have and some of us are high risk borrowers, so they factor that into the loans that they give us. And then you'll find that sometimes even us, the people who are buying, who are getting these loans, we do not understand what kind of loan we want to get or which kind of bank doesn't offer. So we do not shop around. So we'll end up paying the high debt. But I think most importantly is that most of these banks are trying to cover their costs. From if I would like to understand them, but I also understand that there are arguments where people say that maybe the banks are taking advantage of us, they're taking advantage of their customers, and they therefore want to make more profits. But also you need to get into their shoes and understand where they are coming from. So thank you. I'll move on to the next questions. So Cobbs was saying, consider a situation where you own a bar. you need a big screen, fridge. Most of these don't bring in money, but they are necessities to such a business. Yes, some of these things you might find that, for example, if you're a bank, if you're a bar owner, some of these things may be the ones that will help you to attract the kind of customers that you need, that will then bring in the money that you need. Yes, you could utilize that to be able to take up that loan. Okay. So yes, I do understand that, and it's a very valid argument. If I can move on to the next set of questions that I see. William was asking, can I borrow to settle a loan that is about to mature with bad consequences? In the essence, buying more time. William, my advice would be that in the short term, it could look like something that is adding value to you, or something that is getting you from the ditch. But if you find that you are borrowing to settle another loan, it's time for you to sit down and reflect. You are most likely already having bad debt. If you find that you have to borrow to be able to settle a loan, most likely you have bad debt that is running with you, and that is a red flag that you must sit down and settle. You must check yourself, check your lifestyle, check the reasons why you took the loan, check whether you're indeed adhering to some of these reasons, check if this loan is bringing you value. I would like to say that it can be short-term medicine, but it is not sustainable. And you must try to avoid these circumstances as much as you can. You must make sure that you avoid yourself from getting to this instance where you have to borrow to settle another loan. Okay, hope I'm very clear with that. So I wouldn't advise it. I wouldn't advise you to get there. But if you find that you're already there and you have no other option, yes, you could choose to get a loan that has lower interest rate to cover up a loan that has higher interest rate. That is fine once you find that you are already there. But even before you get there, you must make sure that you avoid these circumstances. Those are some of the characteristics that you're now struggling with your loan, and it is indeed bad debt. All right, thank you. Thank you, members. All right, I would like to make a small comment to John Sempala's statement that bank loan agreements are like software agreements. You either agree or not. And yes, John, it's very true in one way or the other, especially if your bargaining power is still very low. And I'd like to, we have some bankers here, and they will inform you that some people actually negotiate their interest rates. For example, some people negotiate the terms of when they will pay, how long they will pay, and the intervals they will pay, because they have gotten a higher bargaining power when they are going for these loans. Think about the big corporations. Think about high net worth individuals that banks look at, and they know that once they have this money, they will be able to pay it back. You also know that in some companies, like the company I work for, the company negotiates good interest rates for staff whenever they're going to take out loans, and it has partnerships with some of these banks, and that helps them to negotiate. But now, if you're an individual who doesn't have that high negotiating power, and therefore you look at it as take or not, once you find yourself in this situation, but you feel that I really need this loan for whatever reason that I'm going to get it, I would encourage you, look at your options. For example, I know banks that are offering interest rate that is as high as 20%. That is as high as 23%. And they have people that are taking out these loans. But I also know that there are banks that are giving out interest rate that is as low as 16%. You get it? So that means options are always there for you. And beyond that, I'm part of a circle that gives out interest rates that as low as 9% per annum. So do you see that I have a couple of options? So it's not always cast in stone as you may think. As long as you're getting this loan for a good reason, you might find that there's always a better option. So if I go to DFCU and they are giving me the loan at 20.5%, I have an option of going to Housing Finance Bank and I can get this loan at 16.5%. And I'm not making any advert for someone, but I'm just giving examples. Or I can go to Stanbic and they'll give me a similar loan at 16%. Alternatively, I can go to our staff circle and they can give me the same type of loan at 11%. So the options are there for me. As long as I take time to think through the kind of loan that I'm going to get, the reasons for which I'm getting it, and the options available for me. Yes, Bank A might say, yes, for us, we are giving you at this rate within this period. Take it or don't take it. You have another option, visit another bank. And most of these banks, I've found them a little bit flexible, that sometimes they do not require you to have spent with them a long period of time to be able to take their kind of loan. It's just a matter of switching. For example, if you're a salaried person, you switch your salary, and once they get your salary for the first month, they will be able to give you your loan. Or once they have an undertaking with your employer, they will be able to give you some bit of, they'll give you your loan and you'll move. So don't feel that you're stuck. I either take it or not. Look at the different options that you have. But also the other options that you have, you could go to your friends. You could go to your investment circle. I mean investment club. You could go to your employer and get a soft loan. So look at the different options that are at your disposal. That will help you to not feel that I either take it or not. All right, thank you. All right, so Solomon was asking, how about borrowing a higher interest loan to settle a lower interest rate? I'd find that a little amusing, if I could say. So why would I borrow at a higher rate to take a lower interest rate loan? Unless you are referring to the vice versa, which I could understand in such a circumstance, that you took on a high interest loan, maybe because of the circumstance at that time, and then you realize that there's an opportunity for a lower interest rate, and then you choose to take up that. That is definitely understandable, but not like the way you put it or you put it through. Okay, I see a hand from Herbert. Just a moment. Pick up some of these questions in the chat, and then we'll be able to talk. And then could you talk about the details of when loans, of the loans people get? Things like fixed and variable interest rate, which turns up to be a major game changer. And literally, Uganda people just sign papers without getting the details. I think, yes, that's some of the things that I was talking about. Make sure that you understand the terms and conditions of the loans that you're getting. Just to give a hint to those who may not know. So a variable rate means that in certain conditions, maybe if the CBR reduces, that means that the bank would be flexible and reduce for you the rate. But that means that also if it increases and the conditions in the market necessitate, your interest rate could increase. And fixed means that you'll pay that no matter the circumstances, whether the inflation rate increases, the CBR increases or reduces. Once you took out the loan, you have to take it out. So these are some of the things that you need to ask. And I think in future, we're going to have one of these sessions where we shall discuss some of the fine prints that you need to consider as a person before you take out this loan. And like I said, I wouldn't encourage you to just sign papers for the sake of papers. Read through, understand. Whatever you do not understand, ask. In fact, if you are a person who takes high interest rates, if it's possible, engage your personal lawyer and help them to interpret for you so what some of these things mean, or engage someone who is a banker, or engage someone who is a financial advisor to help you understand some of what some of those terms may mean, so that you know what you're getting into. So Nasal was asking, can I borrow at low interest rate or high interest loan? Yes, I answered that. Yes, it's very, very, I would encourage that. Once you find that you already have debt and then you want to reduce the rate, yes, that is, I would ask you to do that. And then could you, okay, so a bank will charge you some percentage of interest even when you take back their money earlier as promised. Yes, that's true. All right, so let me give an opportunity to Herbert Katongole to be able to ask or make the comment that he had earlier. Herbert, over to you. Is Herbert still on the call? All right.
Yes, I got the question, so I just forgot to put my hand down.
All right. Thank you, Herbert. Thank you, Herbert. Thank you, members, for having followed through. I do hope that you found value in today's session. Like I mentioned earlier, yes, we've been purely virtual because of the pandemic, but now that the economy is open, some of our paid sessions are going to be back so that you can always engage with us, become part of the sessions so that you can add more value. You get to interact with me and the rest of the team more often. You get to ask more questions to our speakers. You get to ask more questions to our coaches when you get to attend those sessions. So if you'd like to get in touch with me, those are my contacts. And once again, I would like to remind you that you can visit our YouTube channel, that is Next Life Finance. Personal finance with Darius, so that you can check out some of the videos or the recordings that we've had previously, and make sure that you learn. I have posted the link to the YouTube channel in the chat room, so you can please use that link to visit the YouTube channel and be able to subscribe. Thank you very much for having been part of today's session. Let me make sure I did not leave out any question. I think yes, I think I have one question from Mary Nasali. Is there an ideal ratio of debt income? E.g., if I earn $1 million a month, what is the maximum debt that I should have? Now, first of all, it's going to depend. It's going to depend on a couple of things, and I'll explain some of these things. But typically, especially if I can use an example of banks, most banks will make sure that you do not exceed 50% of your net income. Actually, if you exceed 50% of your net income, they'll start looking at you as a risky borrower, and they will be hesitant to add you more money. So you can use that. I was reading from one source, and they were advising that make sure that it is not more than 43%. Once you get to 43% of your net income, you're getting into a red zone, and you shouldn't aim to get there. But for me, of course, I would advise you to have it as low as possible. So let me explain when I said that it could vary from circumstance to circumstance. So for example, I could be, if I'm earning 1 million and my daily expenses can be covered by 200,000, and I know that with 200,000, I'm fully covered with all my expenses and what I need for living. It is possible that I could stretch and go up to 50%, so that maybe I can buy an asset that is higher in value, as long as I know it is good debt. But then another person could be also earning 1 million, and their living will cost them about 700,000. So of course, that person, they must make sure that whatever ratio they are getting into, it doesn't get into the areas of 30%. So their loan doesn't get into the areas of 300,000 that they have to pay. Then once it gets there, their lifestyle may start to get constrained. And when it starts to get constrained, then they may find themselves going for more debt. Also, if I'm a high earner and I am earning in tens of millions, it's going to be possible for me to take on higher debt, because it means I'll have more disposable income. But the general rule is, make sure that at all times your debt to income ratio does not exceed 2 to 1, 1 to 2 actually. So make sure that at least you keep it within the range of below 50% as much as you can. And of course, from the personal finance world, we want to believe that by the time you get to that area, then you know that your rest of your living expenses can be covered by the disposable income that you remain with after making those monthly payments that are expected of you from this loan that you'd have taken up. So your circumstances could determine, but your lender could also determine. Another lender may see that once you reach 40%, you are in the red zone. Another one could look at 50%. Another one could look at 60. But for me, from my side, keep it as low as possible. If you can keep it below 10%, the better for you, as long as you are progressing and achieving the rest of your financial goals. So thank you very much. Once again, and make sure that you go to our YouTube channel for the recording, and also make sure that you subscribe, and also look out for communication about our sessions that will be rolling out now that the economy is open, so that you do not miss out on our knowledge and sharing that we always have on a continuous basis. I want to thank you and wish you a great week ahead.